If I were you, I wouldn't blink while watching this video, because missing this could cost you everything. I'm talking about your savings, your future home, your retirement dreams. We've been here before, over and over, and unless you understand how these crashes unfold, you might fall into the exact same trap that destroyed millions of lives during the last financial collapse. Hi, I'm Richard Blake, and what I'm about to show you is not taught in schools, nor whispered in investor meetings. You'll see how each economic bubble, no matter how shiny or sophisticated it looks, ends in the same old mess: a brutal stock market crash, panic, and silence. But what if you could recognize the warning signs before the next one hits? Today you'll uncover 5 of the most destructive financial crashes in history, and what they all have in common. But more than that, you'll start seeing patterns that most people miss. This isn't just about looking back, it's about protecting what's ahead. And if you stay with me till the end, you'll walk away with a mindset that could make all the difference when the next bubble bursts. They called it the safest bet on Wall Street. But behind the shiny suits and PowerPoint presentations, the 2008 financial crash was a ticking time bomb wrapped in mortgage-backed securities. Banks were handing out loans like candy, bundling them into complex products, and passing the risk down the line. Nobody really stopped to ask, what happens when the people at the bottom can't pay anymore? Picture this: someone with a $30K salary gets approved for a $500K house loan. That's not ambition, that's insanity. But it happened because the system believed housing prices would rise forever. The illusion was backed by credit default swaps, derivatives, and a mountain of leverage that made everyone feel invincible. Until the bottom fell out and a global financial collapse followed. You don't need a Wall Street badge to fall into the same trap. Every time we chase rapid growth while ignoring real value, we play with the same fire. Whether it's investing in overhyped stocks, over-leveraging personal credit, or buying properties we can't afford, the lesson is clear: productivity must come before debt. And if we're not careful, we might just repeat the past again. Just like we did during the dot-com bubble. It started with a dream, the promise of the internet revolutionizing everything. And while that dream eventually came true, the late 90s dot-com bubble was built on something far shakier: hype. Startups with no revenue and no real product were valued in the billions just for having a .com in their name. Investors weren't asking, how does this make money? They were too busy imagining Lamborghinis. Companies like Pets.com and Webvan raised massive funds, spent wildly, and collapsed just as fast. These weren't businesses, they were bubbles. The media helped fuel the frenzy with headlines about 22-year-olds becoming millionaires overnight. People mortgaged homes to buy tech stocks. And then, the stock market crash came crashing in. Billions evaporated in months. If you've ever jumped into a next big thing because TikTok or Twitter told you it's hot, congrats, you're not alone. But here's the trick: always check the fundamentals. Is there revenue? Is there real demand? Does the business solve a problem? Without those, you're just another player in the next economic bubble. And history has a funny way of repeating itself, especially when energy and inflation enter the stage. The 1970s weren't just about bell-bottoms and disco, they were about stagflation. That rare economic nightmare where inflation rises, but growth stands still. It all kicked off with the OPEC oil embargo. Suddenly, gas prices soared, lines at the pump stretched for blocks, and the cost of everything skyrocketed. But wages? They barely moved. Welcome to the hidden tax of inflation. People couldn't afford basic needs. Governments tried printing more money, but that only fed the beast. Inflation ballooned, interest rates hit the sky, and the economy froze. The US learned the hard way what happens when you rely too heavily on a single resource. And while geopolitical tension lit the fuse, the underlying problem was overconfidence and poor diversification. If you're putting all your financial hopes into one source, like one income stream or one investment, you're doing what countries did back then. Build buffers. Learn about diversified ETFs or side hustles not tied to global commodities. Because when prices rise and your wallet shrinks, the next money crisis won't feel like a headline. It'll feel like your life. And speaking of inflated prices detached from reality, Imagine believing your house will double in value every year. In Japan during the 1980s, that wasn't a fantasy, it was national policy. Fueled by low interest rates and easy credit, people rushed to invest in real estate and stocks. Banks gave out loans like vending machines, and asset prices soared. But when reality caught up, the asset bubble popped, and Japan fell into the infamous lost decade. Some Tokyo land was priced higher than entire US cities. Companies were buying golf courses instead of innovating. It wasn't just greed, it was cultural optimism, a belief that things only go up. But when the correction hit, people lost homes, businesses crumbled, and banks nearly collapsed. The economic scars are still visible decades later. It's tempting to think we're smarter now. But are we? When we see NFT art selling for millions, or stocks with no profits trading at sky-high PE ratios, we should pause. Are we investing or gambling? Are we chasing growth or following a trend? The market crash in Japan wasn't an anomaly, it was a preview. And before that, there was a crash so devastating it redefined the global economy. October 1929. One moment, investors were popping champagne. The next, they were jumping out of windows. The Great Depression didn't start overnight, but the crash was swift. Margin trading let people borrow money to buy stocks, some putting down just 10%. When prices dipped, panic followed. Banks failed, families lost everything, and the financial system? It cracked at the seams. Trust disappeared. The markets weren't just numbers anymore. They were fear made visible. Unemployment soared. Soup kitchens became normal. People started stuffing cash under mattresses. The financial collapse spread from Wall Street to every main street in the world. All because too many believed the boom would never bust. This story isn't ancient history, it's a mirror. When people stop trusting the system, everything shakes. Whether it's banks, crypto platforms, or the government itself, trust is the glue. Once it breaks, no one knows where the bottom is. And while today's headlines might feel different, there's a thread running through every crash. Here's the cold truth. Every economic collapse from 1929 to 2008 sings the same tune. Excessive leverage, blind optimism, speculation over fundamentals, then panic. It's not just history repeating, it's human behavior on a loop. We crave growth, we fear missing out, and we ignore red flags when the gains feel good. Think of the boom and bust cycle like a roller coaster. The climb is exciting, the peak feels invincible, and the drop comes when you least expect it. Right now, debt levels are rising, asset prices are inflated, and speculative trends like meme stocks and get-rich-quick coins are everywhere. Sound familiar? The lesson isn't to fear the markets, it's to respect them. Build a strategy based on fundamentals. Study economic history, not just TikTok finance gurus. And most importantly, ask the hard question. Are we nearing another cycle? Because those who understand these patterns don't just survive the crash, they prepare for it. And to truly grasp what's coming, you need to see how these crashes still echo in today's world. So now that you know the truth, what are you going to do with it? Will you keep following the crowd, blindly chasing the next hype train? Or will you take control, dig deeper, and build a strategy that actually protects your future? Because here's the hard pill to swallow. Financial crashes don't destroy everyone, just the ones who ignore the warning signs. Ask yourself, are you relying on speculation or solid fundamentals? Are your finances prepared for a sudden downturn, or are you gambling on the assumption that things will always go up? Be honest. And most of all, be proactive. Study history, diversify smartly, and start thinking like someone who's seen the storm before it hits. If this video opened your eyes or made you rethink even one thing about your financial life, do me a favor. Hit that subscribe button, turn on the notifications, and stick around. Because the next crash, it's not a matter of if, it's a matter of when. And here you'll always be one step ahead of it.